We warned you. We told you that when the banks began to lose control of the price, they would not simply stand by and let the market function. We told you that when the short sellers faced extinction, the system itself would intervene to save them. We told you that if they couldn't win the game, they would change the rules of the game. Today, Tuesday, January 13th, 2026, they changed the rules. While you were watching the price of silver attempt to breach $86 an ounce, the Chicago Mercantile Exchange, the CME Group, issued an emergency advisory notice. Notice number 26 to versive 19. To the average investor, this is just a boring PDF document. To the insider, this is a declaration of war against the silver price, effective immediately. The CME is altering the way it calculates margin requirements for precious metals. They are shifting from a set dollar amount to a percentage of notional value. Specifically, they have set the margin requirement for silver at 9%. Let me translate this into plain English. With silver trading near $85 an ounce, this change effectively hikes the cost of holding a silver contract by approximately 15%. It raises the margin from $32,500 per contract to over $38,250. That is an instant increase of nearly $6,000 per contract. Why did they do this? And why did they do it right now? They did it because yesterday morning, silver went vertical. It gapped from $82 to $85. It pushed as high as $86 in the early electronic session. The commercial banks, who are short millions of ounces of paper silver, were staring into the abyss of insolvency. They needed the buying to stop. They needed to force the leverage out of the market by raising margins. The exchange forces every trader who bought silver on borrowed money to make a choice. Wire us $6,000 in cash right now, or we will sell your position for you. This is a liquidity drain. It is designed to trigger a cascade of forced selling. It is the exact same weapon they used to crash the silver market in 2011. It is the same weapon they used in 2020. And for a brief moment this morning, it looked like it worked. Look at the 30-minute chart we have been analyzing. Look at the red candles on the far right side of the screen. At the exact moment the margin news hit the terminals, the price of silver collapsed from $86 down to a low of $8,357. That drop was not natural selling. That was the algorithm reacting to the rule change. That was the sound of leverage specs being liquidated, because they couldn't afford the new anti to stay at the table. The mainstream media will tell you this drop proves the rally is over. They will tell you that the fever has broken. They want you to look at that red candle and feel fear. They want you to sell your physical silver because the paper price dropped $2. But before you panic, you need to look closer at the chart. You need to look at what happened after the smash. In 2011, when they hiked margins 5 times in a week, the price of silver crashed 30% in days. It fell from $50 to $35. It was a massacre. Today, they hiked margins by 15%. A massive punitive increase, and the price dropped $2.50. And then look at the very last candle on the chart. Look at the long wick at the bottom. The price dipped to $8,357, and it was immediately bought back up. As I speak to you right now, silver is trading at $83.97. It refused to die. This is the most bullish signal we have seen in this entire cycle. The empire fired its biggest weapon. They actively made it more expensive to buy silver. They tried to break the back of the bull market. And all they got was a $2 dip that is already being bought. Why didn't it crash? Why is this time different? Because the buyers at $83 are not using margin. They are not speculators betting on a chart. They're industrial buyers. They're sovereign wealth funds. They are the cash buyers. You cannot margin call a buyer who pays cash. If Samsung needs silver for a battery, they do not care what the CME margin requirement is. They're not buying a futures contract to speculate. They are buying it to take delivery. If the price drops to $83, they just buy more because it is on sale. The margin hike only hurts the paper longs. It does nothing to stop the physical longs. In fact, it helps them. It allows them to scoop up cheaper metal from the weak hands who got shaken out. This confirms our thesis that the market has bifurcated. The paper market is being manipulated by rule changes and margin hikes. The physical market is being driven by pure, unadulterated scarcity. The banks are trying to put out a forest fire with a water pistol. They can dampen the flames for a few minutes, but the heat is too intense. But the margin hike is not the only sign of systemic panic we saw today. While the exchange was busy changing the rules, the United States government was busy calling for help. We have received reports that Treasury Secretary Scott Bessant convened an emergency meeting with G7 finance ministers this morning. The official topic: securing supply chains. When a Treasury Secretary calls a meeting about supply chains in the middle of a price spike, it is code. It means we have run out. It means the strategic stockpile is empty. If the margin hike was the financial response to the silver crisis, the news we received this morning from Washington, D.C. is the political response. And if you know how to read between the lines of diplomatic press releases, the political response is far more terrifying than the financial one. While the CME was busy changing the rules of the casino to save the banks, the United States Treasury was busy trying to save the economy itself. We have confirmed reports that Treasury Secretary Scott Bessant convened an urgent, unscheduled meeting with the finance ministers of the G7 nations this morning. The Group of Seven, the economic NATO, the most powerful financial bloc in the Western world. They didn't meet to discuss climate change. They didn't meet to discuss tax rates. According to the official communique, they met to discuss solutions to secure and diversify supply chains for critical minerals. Now, to the uninitiated, that sounds like boring bureaucratic language. It sounds like standard government procedure. But you have to look at the timing. You have to look at the context. Why did they call this meeting today on Tuesday, January 13th? They called it because silver hit $86 yesterday. They called it because the Shanghai premium blew out to $8. They called it because the global inventory of the most conductive metal on Earth effectively went to zero over the weekend. When a government says they need to secure a supply chain, it is code. It is a polite diplomatic way of saying we have run out. It is an admission that the flow of material has stopped. And when they say they need to diversify, it is code for we are too dependent on our adversaries. Think about where the silver comes from. China is the third largest producer and the largest refiner. Russia is a massive producer. The BRICS nations control a huge percentage of the global supply. The G7 finance ministers looked at the board this morning. They saw the Shanghai vacuum sucking metal out of London and New York. They saw the retail tsunami draining the U.S. mints, and they realized that the West is naked. The United States government sold off its strategic stockpile of silver decades ago. We had zero strategic reserves. We rely entirely on the just-in-time global market. But as we discussed in our previous reports, just-in-time is dead. We are now in the era of just-in-case, and the United States government has just realized it has no case. This meeting connects directly to the events of January 3rd in Venezuela. Remember Operation Absolute Resolve? The media told you that was about democracy. We told you it was about oil. It was stage 4 empire behavior, desperate resource acquisition. Now 10 days later, we see the same panic hit the metals market. The empire is realizing that it cannot fight a kinetic war, build a green energy grid, and maintain a digital economy without massive amounts of silver. Modern warfare is electronic. Every Tomahawk missile, every F-35 fighter jet, every drone, every satellite requires silver. It is the best conductor of electricity in the known universe. You cannot build a guidance chip without it. If the supply chain snaps, which the dealer delays suggest it already has, the military-industrial complex grinds to a halt. This is why Secretary Bessant is involved. This isn't just about the price of a coin. This is a matter of national security. The system response is a coordinated effort. The CME raises margins to smash the paper price and shake out the speculators. That buys the government time. Then the Treasury convenes the G7 to coordinate a strategy to secure physical metal off-market. They are trying to form a buyer cartel. They want to coordinate with Europe, Japan, and Canada to secure mining contracts in friendly jurisdictions like Mexico and Peru before China buys it all. But there is a problem. The Chinese are already there. The Chinese have been signing off-take agreements for years while the West was distracted by ESG scores and paper derivatives. The G7 meeting is a sign of weakness, not strength. If they had the metal, they wouldn't need to meet. If the market was functioning, they wouldn't need to secure it. The fact that this meeting happened today in direct response to the price spike validates everything we have been saying. It proves that the $86 price isn't a bubble. It is a signal of a profound systemic shortage that has reached the highest levels of government. And notice the language shift. Critical minerals. For decades, they told you silver was just a precious metal, a shiny rock for jewelry, a barbarous relic. Now suddenly it is a critical mineral. This rebranding is intentional. By classifying silver as critical, it opens the door for government intervention. It allows them to use the Defense Production Act. It allows them to prioritize industrial allocation over retail investment. It sets the stage for what comes next: rationing. If Samsung needs silver for batteries, and Rathen needs silver for missiles, and you want silver to protect your wealth, who do you think the government is going to prioritize? They are going to prioritize the missiles and the batteries. The G7 meeting is the first step toward a bifurcated market where the public is pushed out. They will try to make it difficult for you to buy. They will raise premiums. They will implement purchase limits just like we saw with Costco this week. They will demonize hoarders. They want the metal for themselves. So when you see the price of silver drop $2 because of a margin hike, do not get discouraged. Get angry and then get active. Because the very people who are smashing the price on the chart are the same people holding emergency meetings to figure out how to get their hands on your metal. The CME margin hike was the distraction. The G7 meeting is the reality. They know the bond market is breaking, and we saw that with the India sale. Now they know the commodity market is breaking. They are fighting a two-front war against economic gravity, and just like the margin hike failed to crash the price below $83.50, the G7 meeting will fail to create new supply. You cannot print a silver mine. You cannot legislate a new deposit into existence. It takes 10 years to build a mine. Secretary Bessant can hold all the meetings he wants. He can issue all the communiques he wants. But unless he has a magic wand that can transmute lead into silver, he is out of luck. The system response is failing. The paper tools are blunt, the political tools are slow, and the market is moving fast. In the next part of this deep dive, we are going to look at the Shanghai Shield. We are going to explain why the arbitrage gap with China is the ultimate defense against Western manipulation, why the CME can raise margins to 50%. And it won't matter as long as Shanghai is trading at $93. The West is trying to close the door. The East has ripped it off the hinges. The G7 is in panic mode. The CME is in panic mode. Are you in panic mode, or are you prepared? We have analyzed the weaponization of the exchange rules by the CME. We have analyzed the geopolitical panic at the G7 level. But now we must answer the most important question of the day. Why didn't it work? In 2011, when the CME hiked margins, the price of silver collapsed immediately. In 2020, during the pandemic crash, margin calls exacerbated the sell-off, driving silver down to $12. History tells us that when the exchange raises the cost of poker, the players fold. But today, Tuesday, January 13th, the players did not fold. They called. The price of silver dipped to $8,357 and then bounced. It refused to break. It stood there defiant, absorbing the blow like a heavyweight boxer who just shook off a haymaker. Why is this time different? What has changed in the structure of the market that allows silver to shrug off a 15% margin hike? The answer lies 7,000 miles away. It is called the Shanghai Shield. While the CME was busy trying to smash the price in New York, the Shanghai Gold Exchange closed its afternoon session with silver fixed at $93.31. Do the math. That is a spread of nearly $10 between the paper price in the West and the physical price in the East. In previous cycles, this spread did not exist. In 2011, the price in London, New York, and Shanghai was roughly the same. The global market was unified. When New York sold, everyone sold. But the market has fractured. The West is trading paper, the East is trading metal. And because the East is willing to pay $93, the price in the West literally cannot fall significantly below $83. Here is the physics of the Shanghai Shield. If the CME succeeds in smashing the price to $70, does that hurt the bull market? No. It accelerates it. If silver drops to $70 in New York while Shanghai pays $93, the arbitrage profit jumps to $23 an ounce. That is a risk-free return of over 30% just for shipping a bar of metal across the ocean. Every trader on Earth would buy the COMEX smash and sell into the Shanghai vacuum. They would drain the COMEX vaults in 48 hours. This is the trap the banks are in. They are checkmated by the arbitrage. If they smash the paper price, they lose their physical inventory to China at a discount. If they let the price rise, they lose their solvency on their short positions. They have to choose. Save the metal or save the dollar. The inventory data we received this afternoon proves they are losing the metal while the price was being smashed on the screen. The vaults were being raided in reality. Look at the depository statistics released by the CME Group today. It is a sea of red ink. 565,000 ounces withdrawn from Masa, 615,000 ounces withdrawn from Brinks, 351,000 ounces withdrawn from C&T, 791,000 ounces withdrawn from StoneX. In total, over 2.2 million ounces of silver were removed from the COMEX system in a single day, and critically, the registered category, the silver available for immediate delivery, dropped by nearly 400,000 ounces to just 123 million ounces. This is the bleed. The margin hike didn't stop the bleed. It accelerated it by smashing the price to $83.50. The CME inadvertently put silver on sale for the very entities that are draining the vaults. They are feeding the beast. They are trying to starve. This connects back to the G7 meeting. Secretary Bessant knows that the COMEX is bleeding. He knows that the metal is flowing from west to east. That is why they are talking about securing supply chains. They are trying to put up a fence. But you cannot fence in a market with a $10 price gap. Capital is fluid. It flows to where it is treated best. And right now, silver is treated best in Shanghai. The Shanghai Shield is the reason you should not be afraid of the volatility. When you see a red candle, realize that it is hitting a floor made of solid concrete. That floor is the Chinese bid. Unless the price in Shanghai crashes, and we see no evidence of that given the industrial demand in China, the price in New York has to hold. This effectively puts a put option under the market. The downside is limited by the arbitrage. The upside is unlimited because the paper shorts are insolvent. We are witnessing the balkanization of the silver price. For 100 years, New York set the price and the world followed. Now Shanghai sets the floor and New York struggles to keep up. The margin hike was a desperate attempt to reassert control. It was the empire trying to remind the market who is boss. But the market looked at the $93 price in China and realized the empire has no clothes. The paper tools, margins, spoofing, wash trading only work when the physical market is asleep. But the physical market is wide awake. It is hungry and it is eating the COMEX alive. The 2.2 million ounces that left the vault today are never coming back. They are going to be melted down. They're going to be turned into solar panels. They are going to be shipped to Samsung. They are gone forever. So the system response has failed on two fronts. The financial weapon margins failed to crash the price, and the physical weapon inventory is depleting rapidly. What is left? What is the next move for the establishment? If they cannot stop the price with margins and they cannot stop the drain with policy, they have only one option left. They have to close the exit doors. They have to make it harder for the retail public to participate. We are already seeing this. In the final part of this deep dive, we are going to look at the retail lockout. We are going to discuss the new restrictions at Costco, the sellout at the US Mint, and the backwardation in the futures contracts. The system is trying to ring-fence the silver market to keep you out. They want the metal for themselves. And if you don't act now, you might find yourself on the outside looking in. The Shanghai Shield held. The price is $83.89. The short sellers are still underwater, and the vaults are 2 million ounces lighter than they were yesterday. The trend is unbroken. We have arrived at the conclusion. We have dissected the financial war declared by the CME through margin hikes. We have exposed the geopolitical panic of the G7 meeting. We have analyzed the Shanghai Shield that prevented the price collapse. Now we must look at the final piece of the puzzle, the piece that affects you directly. If the establishment cannot crash the price using paper and they cannot secure enough supply from the mines, what is their final move? Their final move is to close the gate. They need to stop the public from draining the remaining inventory. We are seeing the first clear signs of retail rationing from the largest retailers in the United States. Look at Costco. For the last 2 years, Costco has been a major source of silver for the average American. They sold tubes of eagles and bars of gold. It was free-flowing. But today, that changed. We have confirmed reports that Costco has implemented strict order limits on physical silver transactions. They are now limiting sales to 1 transaction per membership with a hard cap on units. Why would a retailer limit sales of a product that is flying off the shelves in capitalism? If people want to buy, you sell. You don't tell them stop. You only limit sales if you're terrified of running out. You only limit sales if you cannot replace the inventory you are selling. Costco knows that if they let people buy unlimited amounts at these prices, their entire national stockpile would be gone in hours. This is rationing. It is soft rationing, but it is rationing. And look at the United States Mint, the government entity responsible for supplying the people with constitutional money. They released the 2026 Silver Eagle coins this morning, and they are gone. The U.S. Mint has announced an immediate one-month delay on new orders. Backordered. Think about that. The United States government, with all its resources, with all its vaults, cannot stamp a 1/0 coin fast enough to meet demand. This is a failure of the sovereign supply chain. It tells you that the just-in-case panic has overwhelmed the federal capacity to produce. But the most technical and perhaps the most damning signal of all is happening in the futures market itself. It is a phenomenon called backwardation and specifically backwards rolling. Usually when a futures contract expires, traders roll their position forward. They sell the expiring month and buy the next month. It is a routine process. But look at the data from the CME Open Interest Report. We are seeing something bizarre. We are seeing traders rolling backwards. Traders are fighting to stay in the delivery month. We saw 369 delivery notices issued for January, but the open interest only fell by 233 contracts. This means that for every person trying to leave the market, there is someone else fighting to get into the immediate delivery window. They are grabbing the January contracts because they don't trust that the metal will be there in March. This is the definition of a squeeze. The shorts are trapped. The longs are demanding delivery, and the exchange is trying to hike margins to force them apart. So what is the verdict on this historic day? The system response has failed. The CME fired its bazooka of 15% margin hike, and the price is still trading near $84. The Treasury called the G7, admitting they are vulnerable. The retailers has started rationing. The system is blinking red. They tried to break the psychology of the market today. They wanted you to see that margin hike and sell in fear. They wanted to paint a red candle on the chart to break the momentum, but the market didn't break. The Shanghai Shield held. The physical buyers stood their ground. This $83.90 price is not just a number, it is a victory flag. It represents the moment the market realized that the banks are powerless against the physical shortage. So, what should you do? If you are holding physical silver, do not let them scare you out of it. Do not let a $2 dip caused by a rule change shake you from your position. That metal in your hand is the only thing protecting you from the currency crisis that the G7 is frantically trying to manage. If you are looking to buy, understand that the window is closing. Costco is rationing. The mint is delayed. The premiums are rising. The easy silver is gone. We are now fighting for the scraps. The path to $100 is now clear. The resistance at $80 is gone. The resistance at $85 was tested and held. The next major resistance is the Shanghai price at $93. We are going to close that gap. It is simply a matter of physics. The empire struck back today, and the empire missed.